Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 251st VideoCast podcast for the week ending August 6, 2024. A lot of great stuff to cover this week, and doing it a bit early because I've got to travel down to Virginia for the girls' zones championship, and got pushed back a day, but we'll get there. First and foremost, want to congratulate Mimi. We do family first, then we get down to business. Mimi and Annabelle swam the Nutmeg State Games this weekend. 4 golds and a silver for Mimi, 4 golds for Annabelle, plus 2 records in the 50 back and 100 free. Way to go, girls. Unbelievable. And then they had that was me at Fox on Friday for Liz Clayman. We did it out of the pod. That's the main bullpen. I always like to show people that kind of behind the scenes for the new listeners, like to see what it looks like to be at Fox. And this was their divisional championship for the summer swim club meet. I think they were down at Greenwich on Monday, did a great job down there. And I think that's all the updates for the week. We'll have more for you. First, I want to thank Liz Clayman and Jake Mack for having me on the Clayman Countdown on Friday with Nick Timmeros, the Fed whisperer himself from the Wall Street Journal. Covered a lot of important stuff here, including the SOM rule, the labor report. We're going to listen in now.
A rate cut, but a jumbo or supersized rate cut in September. Nick Timmeros is the Wall Street Journal's all things Fed correspondent who understands the Fed's thinking better than just about anybody. And trader Tom Hayes has been scrutinizing which stocks maybe look like a buy in this sell-off. And Nick, I'll start with you. 3 days ago, Fed funds futures fully expected a September rate cut of about 25 basis points, right? But saw only a 10% odds of a larger 50 basis point easing. Look at Fed funds futures right now. One ugly jobs report, it skyrockets to near 70% for a 50 basis point cut. What do you think Chair Powell is mulling right now? And is the market way ahead of itself versus what the Fed is thinking?
Well, Liz, is the market ahead of itself? I mean, probably not, but the market is sort of assuming that the current trends continue. The Fed doesn't really have to make up its mind for another 6 or 7 weeks, right? They don't meet for another 7 weeks. So I'm sure we'll hear from Fed officials, a lot over those 6 or 7 weeks, but they don't really have to make up their mind now about whether the first cut will be 25 or 50. That's obviously where the debate is going to be. What I'm hearing today from a lot of analysts is, okay, you can do 25 at every meeting. There are 3 meetings left this year, and that's probably locked in now as a base case for the Fed. There are a number of people, though, who have said you need interest rates to get closer to neutral sooner. You need to be closer to 4% by the end of this year. And so you saw JP Morgan and Citibank put out calls this morning for 50 basis point cuts in September and November and another quarter point in December. I don't think you're going to hear Fed officials talking about that right now, but the next meeting is still a ways away. So they'll have another jobs report before that meeting. We'll be able to see a lot more than we can today.
Mm-hmm. June, July, September, November of 2022, you saw jumbo rate hikes. So we know that the Fed isn't afraid of making big moves of 75 basis points even. But the question is, now will Citi and JP Morgan be right? They are both claiming that September and November will see a 50 basis point cut. Tom, not only is there no rotation out of mega cap tech and into the Russell is getting absolutely slammed, biggest percentage loser here. What's behind the panic selling there? And if there's any money leaving and going into somewhere, where do you think it's going?
Well, the market's afraid of 2 things, Liz. First off is a recession because the SOM rule was triggered today. That's when the unemployment rate, 3-month moving average, moves up 0.5% higher than the lowest 3-month moving average 12 months before. That's a mouthful, but the markets are worried about a recession. That's why small caps are down. That's why yields are down. The second thing that's happening is the unwind of the Japanese carry trade. The Nikkei is down 20%. That's a lot more than the NASDAQ. And that's because the Bank of Japan has been the global liquidity provider while the West tighten to fight inflation, but the Fed has not stepped in now that the Bank of Japan is tightening, so you have this liquidity dislocation pocket. And guess what's happening? It's a big unwinding of the most crowded trades because liquidity is drying up, and the most crowded trade, as you know, was the Magnificent Seven, and the second most crowded trade was short the Japanese yen. So with yields lower, what we're looking at, Liz, is dividend payers. That's where the opportunity is right now.
Yeah, opportunity in DoorDash, it's up 7%. We do have a little bits of green on the screen here. Nick, before we go here, as you're looking at this market action and specifically the panic that's in the VIX, I mean, that's just sort of a one-day situation, but it does measure some concern about the markets. Do you get the sense that the Fed is guided at all by these market machinations and spasms?
One-day moves, Liz, no. But I think what I'm paying attention to here is if this is sustained, does it change sentiment? If you change sentiment, you change businesses' plans to invest. They slash investment budgets. They decide to fire workers. Labor demand is clearly weaker than it was some months ago. And so what I would worry about here is what if businesses have been holding on to workers because they worked so hard to hire them? You know, you heard about all these shortages after the pandemic. And so they've been holding on to them.
Right.
And now like a beach ball under the surface of the water, if they just decide at some point to let people go, you know, that beach ball, it jumps up, and you have to wonder if that creates sort of the recession dynamic that the market is worried about here, and this sort of feeds on itself. So I think that's what you have to wonder about right now.
And a lot of people will be going into dividend-paying stocks, right, Tom? Really quickly, can you cough up a couple of names here very quickly that are paying out dividends so people can wait and kind of hang out there?
Yes, Crown Castle International, 40,000 cell phone towers, 5.5% dividend yield. Baxter International, medical devices and supplies, 3.2% dividend yield. And Hormel Foods bringing you world-famous Spam at a 3.5% dividend yield while you wait, a steady grower.
All right. Nick and Tom, thank you very much on a rockin' day. We are about 52 minutes.
And we're back. And then I had the pleasure to join Charles Payne on Monday to talk about the Japanese currency trade, Japanese carry trade unwind, some picks, and a lot more. Thanks to Nick Palazzo and Charles for having me on. We're going to listen in now.
All right, so the overarching rationale for the Fed not to cut rates is that it would panic the markets. And listen, I get that in most cases in life, you don't want to panic. But I got to tell you, I have personally been in positions and places where those knee-jerk moves saved my life, right? And also at times it saved me financially from a lot of heartache. I want to bring in now Great Hill Capital Chairman Thomas Hayes. Thomas, so I know you're one of those steady Eddie guys. Check out your posture, right? Just cool and easy, like a modern-day Paul Newman, right? But you know, it's like the whole steady crowd doesn't want the Fed to overreact. Yeah. By the same token, though, the markets are pushing them around, right? And, of course, you have to wonder how much things have changed since the moves from the Bank of Japan. I mean, the Fed doesn't just have to deal within the context of the U.S., but it's also got other central banks around the world that are making aggressive moves.
Yeah, this is a big deal. I think the carry trade unwind is actually pretty important. You had the Nikkei drop 25% in a very short amount of time. Basically, what you have is the funding currency, the Japanese yen. Institutions were borrowing that for free to buy the most crowded trades, the Magnificent Seven. So as the cost of capital went up, they had to return that capital and unwind the Magnificent Seven trades. So it's like the Fed, as the Bank of Japan hiked, had the opportunity to cut to make up that illiquidity. Right. They didn't do that. So where's the liquidity going to come from? We've had 35 central bank cuts globally in the past 3 months. The last time we had that many cuts was in 2020, April 2020. We had like 95
But have we ever had this sort of carry trade relationship with anything? I mean, do we have like that with the Bank of Pakistan or something like that? You know what I mean? Like, I'm being a little facetious here, but I've never heard of this sort of relationship where like Japanese households were buying our tech stocks and buying our treasuries, by the way. And who buys that now?
Yeah, so this was pretty big in 2006 and 2007 when you had the low cost of capital with the Japanese yen. It's reworked itself. I think now you're probably going to find out 1 or 2 weeks from now, you've been around, maybe a couple funds blew up over the weekend. This felt like abnormal selling that we saw, structural selling, which creates opportunity if you have cash to deploy.
So let's talk about the opportunity. Right now, you say we've got a declining rate environment, declining U.S. dollar, and there's specific areas that historically really work out.
That's right. First and foremost, dividend payers, that's nice in a day like today. You get a little bit of safety, you get a little bit of yield while you wait. But with lowering rates, people want the yield, and they're going to move back from money markets into dividend payers for sure. Cyclicals, we're seeing the earnings growth of the unmagnificent 493 accelerate while the Magnificent 7 decelerates because margins are compressing from the CapEx spend. Then small caps started to go, and they just got whacked last week. They'll be back because the earnings growth is going to go from 4% this year to 17% next year, even if it's a little less. Also, after the first cut, they outperformed large caps by 11% in the first 12 months. And then internationally, guess which group did the best in the last 5 days? China. China was only down a few percent while, the Nikkei was down 25%.
Would you buy China specifically, or would you buy like EM? How would you go about this?
Look, I've been bagged in this stock for like a year and a half. I own Alibaba. It's a huge company, a huge outs, the cheapest AI play in the world. It's done nothing for a year and a half. I think this is ready to roll. They're going to report on August 15th. So I like the environment with a weaker dollar, with rates coming down, and with the hot money coming out of Japan and back into China could be an opportunity.
We've got a minute to go, enough time to go over some of your individual ideas that you like here. CCI, Crown
Castle. I was on with you earlier. This stock's come up a little bit, but you still get a 5.5% yield. It's got 40,000 towers. They're selling the small cell fiber business to delever the balance sheet. New CEO, Steve Moskowitz.
I've been waiting for this stock to go to the moon, though, for like 10 years.
It's gone up like from 100 to 115. You collected a yield in the meantime. As rates come down, it'll stay up there.
Hormel's been doing pretty well lately.
Yeah, brought to you by Spam, right? I mean, they got Spam, they got Skippy, they got Planters. This is a steady grower. It got beat down, 3.5% yield. We like this, particularly in a defensive environment right now until we figure out what's going on. And then Baxter, medical supplies, medical devices, 3.2% yield. They're spinning off the kidney business. It'll re-rate the multiple back from 10 to a normalized 15 multiple as that gets done toward the end of the year.
All right, so the bottom line, though, these are defensive. You're getting paid.
Yeah.
You're holding quality names. Yeah. You'll probably sleep better at night.
That's right. We'll get offensive again very soon, but not just yet.
All right, let me know when. Thanks a lot, Thomas. All right, folks. So my next guest.
And we're back. And then want to get to the quote of the week from Seth Klarman. Successful investors tend to be unemotional, allowing the greed and fear of others to play into their hands. By the way, this was a great week, a great example for that. By having confidence in their own analysis and judgment, and like we always say, know what you own, they respond to market forces not with blind emotion, but with calculated reason. Successful investors, for example, demonstrate caution in frothy markets and steadfast conviction in panicky ones. Indeed, the very way an investor views the market and its price fluctuations is a key factor in his or her ultimate investment success or failure. So those of you who have been with us for a while know that we live by this philosophy, and many of you have been picking it up for yourselves and benefiting accordingly. And then final quote of the week is from Warren Buffett. Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. We talk about those type companies every week. We're going to do it again this week. But first, let's get to the overall market. The SOM rule that we referenced with Liz Clayman was triggered on Friday, but the author of that, Catherine, I'm getting her first name wrong, was on Charles Payne saying this time it's different because immigration and COVID hiring skew the numbers. We will see if that's the case or not. We tend to be in that camp. Same thing with the inverted yield curve 2 years ago. People were saying the curve is inverted. We're going to get a recession. I said, hey, we already had the recession. Q1 and Q2 of 2022 was a technical recession. And I think this will prove to be the case as well, provided the Fed steps in quickly enough and gets that done, because these jobless claims numbers and unemployment numbers are moving up. The other thing that happened on the jobs report was that more people entered the workforce, which is also a positive thing, which is why wages are coming down and unemployment is going up because there's a new supply of labor, which we've been waiting for the excess savings to run out, so people had to go to work. By the way, this is my beautiful Hedge Fund Tips mug from my friends in Dallas. And as always, opinions, not advice. Go to hedgefundtips.com and click on terms. We deal exclusively with accredited investors and qualified institutions. Check with your financial advisor before you do anything at all. Labor productivity is going up. Unit labor costs are going down. You can see here, Ward's automotive sales going up. That's a positive thing. We're going to talk about Cooper Standard today. Pretty exciting, actually, after going through every single word of the transcript and the release. A lot of good things happening in the way they're operating and how they'll benefit. Bank of England cutting. Foreign investors dumped most Japan stocks since September of 2022. This number was as of August 2nd. I'm sure this was probably the most Japan stocks ever. We've been saying forever, don't get sucked into Japan. It's now down 25. It fell 25% in 3 days or 4 days. The Topics did, and the Nikkei similar amounts. Economic surprise index. UK is going up. We like that recovery story. We'll talk a little bit about GXO. We'll maybe go into more detail with GXO next week. And what did private clients buy last week before Japan collapsed? Is they bought Japanese equities at the top and got their faces ripped off. August does well in election years. We're still of that camp, which we covered last week. We think we're going to see strength into the first cut, which is late September. And then we're going to see sell the news into the election, and a year-end rally is our base case. This is the chart that I referenced with Charles on Making Money with Charles Payne on Fox Business. There's a back lag of global liquidity coming to bear. The most global central bank cuts since May of 2020. Did you want to be a buyer or a seller of equities in May 2020? You wanted to be a massive buyer. So we've had 35 cuts in the last 3 months. In May of 2022, we had 92 cuts globally. And in April 2009, we had 76 cuts. So I would imagine in the next month, 2 months, 3 months, we're going to see this up to 60 cuts around the globe, which is the perfect environment to be a buyer, not a seller of equities. That was the NASDAQ, I think, corrected 15% peak to trough. We were fortunate, as you guys can go back to the tapes, of taking a bunch of the Alphabet and Amazon, reluctantly, by the way, saying we hate taking this, but we're going to have a chance to buy it a lot lower. Are we buying it back yet? No. But we're keeping a close eye on it. There are just too many other great things to do. 15% NASDAQ drawdown. I think that wasn't even as of, let's see. Russell gave back some gains too, so that happened. But keep in mind the outperformance the 12 months following the first cut. Number one. Number two, this was kind of a global deleveraging scare. Credit unwind, we're probably going to find out, as I shared with Charles, that a couple of funds blew up from margin calls and over leverage over the weekend. And this stuff will get back to normal. The narrative will get back to the normal. Why? Because it's underpinned by earnings. And small cap earnings are going to grow dramatically faster than large cap over the next 12 months, which is supportive of them outperforming after the first cut. As you can see, the Russell fell a lot less than the NASDAQ. VIX got up to 65, which is normally a sign of massive capitulation on Monday. And it looks that way, but don't be shocked if there are some after effects for the next few days. There'll be funds blowing up, margin call liquidating. So you're going to have some aftershocks. Just accept that, use it as the opportunity. But on balance, we remain constructive for the next 6 to 7 weeks. Cyclicals versus defensives, they got smoked out. Here's the Nikkei, and it fell a lot more than this, by the way. This is from August 5th. Unbelievable. Remember, all through this period, I was saying, do not get trapped. Everyone wanted to buy Japanese equities hand over fist. Their demographics are crap. They have Japan is where China will be 5 years from now, okay? But we're going to get a parabolic move in China before then is our base case. And the unwinding of the yen carry trade and getting all this hot Chinese money out of Japan is going to be very positive for Chinese equities. The yuan strength, positive. The bond yield starting to go up, positive. All the things that we need to see China. And even China services PMI went up this week, which was positive to see. We're going to see some earnings in the next few weeks, which is also positive. Nikkei volatility over 75, unbelievable. Yen absolutely collapsing. Remember, all this period here, you were all probably thinking for 2 months, I was saying the yen is going to, you want to get long the yen. You want to get long the yen and short the dollar. And this was one of the biggest moves in history that we just saw. And it's setting things up for everything we need to do. That's the SOM rule that we already discussed. 3 month moving. Anyway, we know what that is. Go back to the Liz Clayman tape. 2-year inflation swap, 10-year break-even rate. Inflation break-evens are now nearing 2%, which means inflation is not only not a problem, but deflation is starting to come into view if they don't move aggressively or they don't move quickly. I think all they really need to do is be dovish, like you saw with Goolsby yesterday. If something breaks, we'll fix it, which is kind of not the ideal strategy. But Daly also said that she's not worried about it, but we're still going to give accommodative policy very soon. Average hourly earnings collapsing. This is what I talk about when I talk about demographics. India, too early. The sweet spot is 35 to 40. When the bulk of the population is 35 to 40, you get the most amount of equity gains and economic gains in the shortest amount of time because that's when people spend the most in their life cycle. China, you've got that right now. But as you look out 5 years from now, they're all going to be over 40. In India, you're not even close there. India is going to be what you want to play after you take all your profits in China 5 years out. And US is in a great situation also with a ton of millennials at 35. And that will continue to be pretty strong throughout 2050 and beyond. We have a pretty good situation because of immigration, because of millennials, etc. Birth rate is better than other places. India, I think, is going to be the best place to invest probably from 2030 to 2050. I think you'll make the most amount of money in the shortest amount of time in India. I think it's too early right now, and they need a lot more development. Summer Olympics, of course, the United States dominated. Wake me up when September ends. August, both normally and in election year, does fine. September is when things get spotty, worst month of the year, which is why if we get the strength we expect into September, that's when we would start to put on some tactical hedges, tactical shorts, raise some cash to buy in the hole in September and early October ahead of the election when fear is acute. S&P 500 returns following 5% pullbacks. This shows the percent of time positive is more than 80% 6 months out, 85% 6 months out, 80% 3 months out, 70% 1 month out. The median return 1 month out is 3%. 3 months out is 5%. 6 months out is 7%. And 12 months out is 11%. So they're basically saying buy the dip. This is from macro charts showing that basically the put call skew got so lopsided. This is usually times you want to be a buyer, not a seller. Then 5% pullbacks occur more than 3 times a year on average. So this is pretty normal stuff. 10% pullbacks occur 1 time per year on average. This is all data going back to 1930. Sometimes when you burden yourself with the facts, it puts things in perspective and puts you at ease during these opportunities. 15% corrections occur every other year on average, and 20% pullbacks occur every 3 to 4 years on average, which is consistent with recessions. Now, we've already had 2 20% pullbacks in the last 4 years, so we're due to not have one for some time. We had one in 2020 and we had one in 2022. Both times we had recession. So we're actually pulled forward a lot of recession and 20% drawbacks. Therefore, we should only be looking more likely for our average 10% a year, which we got more than that in the NASDAQ. I think we came close peak to trough in the S&P. And the 5% pullbacks, those are going to come 3 times a year no matter what you do. And I think we've had 2 already, and we'll probably get the 3rd one in September, October. This was an excerpt from an article in Bloomberg, China becoming appealing. The violent reaction increases the probability of rotation to Chinese equities from Japan, says Frank Benzimra, strategist at SocGen. Chinese equities have low valuations and tend to be relatively more insulated during global stress. The, quote, irrational sell-off in Asia has made under-owned China an opportunity, said William Yuan, director at Invesco Hong Kong. Over the last 2 to 3 years, China's positioning for fund managers has probably been one of the lowest in history. We covered that with Charles. In the context of multiple global macro risks emerging recently, we see mainland China as a relative defensive, especially since many of the country-specific risks appear to be already priced in. You think? Chinese stocks outperformed global during the global market rout while everything else was up. Mainland China, while everything else was getting shellacked, the topics, etc., down 25%. Chinese stocks were outperforming, which is amazing. It's exciting to see. Let's just put it that way. ISM services are going up. New orders up. Mortgage rates are going down. That's a positive thing. That's also going to help refinancing commercial properties. That's going to help refinancing multifamily where there's pockets of distress. That's going to help refinancing small cap companies. All positive things. A number of Britons expecting the economy to get better over the next year reaches 2-year high. We've been talking about the UK recovery, GXO, etc. Magnificent 7 drew down, looks like 18% so far. And that was another thing we were calling for a few months. And then it finally came. We climaxed in June 20th when we put out the article about NVIDIA, the new pain trade. That day it opened at 136, went up to 139 after we said it was the new pain trade. Of course, it always goes against us before it goes for us. And then it just collapsed down. I think it got into the 90s yesterday. 40% drawdown. VIX straight up to 65. Let's pull up some of these RBC charts from my friend over there. This is from Slumer. This came out today. So you can see in the scheme of things, this is not a very big correction. So does it pull back all the way down to 4,500? That's what his chart would imply. I'm not of that camp. I think that this is going to be more subdued in nature, quick, acute deleveraging among leveraged funds. And, maybe that becomes in play in September, October, but I don't think it's going to come in now. This is the monthly seasonality since 1928 that we were referencing. You can see here September is the month that we should start to be more concerned. Election year versus non-election year. You can see the correction here. He's pointing to 49.50. Maybe that'll be the aftershocks. I'm not really in that camp yet. I think earnings have been too strong, but let's see what happens. Sometimes it has nothing to do with earnings. It's just margin calls that throw people off. This other chart he has takes it down to 50.71. NASDAQ already came down to 50% retracement, and 20,000 to 17,000. So yeah, we covered that. 18% on the Mag 7, 40% on NVIDIA. And let's see if there's anything else. So small caps, this, it felt like a lot. It's not really a lot. It's bouncing off this 50-day moving average. I think it's already made its move, and this can start to work higher. Cup and handle back up to new highs. We like that story, supported by earnings, not by hope or dry chart patterns. The topics, that's down more than this. That's 8-1. Why does he have an 8-1 chart on an 8-6 book? That's lazy. This probably got all the way down to here. Let me just see here. TOPIX. Oh, NIK. Nikkei. So yeah, it got down to 42,000 to 31,000. That's a big drop. And now it bounced. Topics weekly, that was as of, yeah, this is a better view. I think he just forgot to update that chart. This here shows that all the year's gains have been erased in Tokyo. The Hang Seng broke out of this downward trend, spiked higher earlier in the year, checked back, now it's starting to go back up. That's actually a very nice retracement. Let's see how that plays out with earnings. 10-year yield collapsed down to 370 and change. Remember, we said 375. As a matter of fact, we did take off a lot of our TLT on Friday and Monday when it just puked out. We had huge profits on some of those call spreads and made many multiples on those. And I think this will trend lower, but it's due for a bounce here. So we may just put that back on sometime in September and get 2 bites at that apple. This fell off his chart, which is pretty wild. This is what we'd expecting. Looking at the dollar, all of these things, why we continue to emphasize it, because they're key for the China trade, all falling into place. The dollar's weakening, collapsed here. The yen, all the hot money coming out of Japan. Canadian dollar, don't worry, you lunatics, loony ticks, Canadian loony. The Canadian dollar will appreciate against the US dollar coming to a theater near you. That's going to be a great trade. Same thing probably with the Australian dollar as China picks back up. Probably same with copper. Let's see if there are any other key charts we want to cover here with him. Semiconductor equipment, huge drop. Avago. Scott's Miracle-Gro, we've covered that a few times. We do like that stock. All the utilities have absolutely rallied. We've been talking utilities forever. Now the hedge funds are getting into them. They're due for a pullback. You watch what happens with those. So if you've run with the utilities that we've been talking about, take some profits now. And you can probably re-add those in September. And that's that on that front. Let's finish up these other charts. Spreads blew out a little bit yesterday. Global PMIs going up, manufacturing, that's good. Financial stress going up from that deleveraging yesterday. Delinquencies going up modestly, but not extreme relative to history, except for student loans, because a lot of them have been forgiven. Auto loans are going up. That will also be helped by lower rates, is financing autos, which is a big deal. Earnings surprise had been better than the pre-COVID average. Q2 earnings surprised to the upside by 5.5%. That is better than the plus 3.7% pre-COVID average. Earnings growth was 15.3% ex energy and financials. That's pretty big. Regular earnings growth was 11.5% all in. We're going to talk about that at the end. Monday's VIX closing level ranks in the 96th percentile since 1999. Some level of capitulation and margin calling going on there, which is why we don't use much leverage. And the largest calendar year peak to trough S&P drawdown just about looks like it hit about 9%. Probably futures hit 10% would be my expectation. If you do from overnight charts, you would see that it actually got to a little correction there. GXO earnings, second quarter revenue increased 19% year over year to a record $2.8 billion with organic revenue growth of 2%. They signed new business wins of approximately $270 million in annualized revenue and got a sales pipeline increase to the 12-month high of $2.3 billion. They completed the Wincanton acquisition in the UK, which we had talked about. All of this is positive. They generated $115 million of cash flows from operations compared to $61 million last year, and $31 million of free cash flow compared with $3 million of free cash flow last year, same quarter. That's a big deal. Remember, this is troughing. The whole world was goods from 2020 to 2022. A lot of pull forward. Then it was working through inventories from 23 and 24. And now they're back on track with a more balanced situation, which is goods and services, which will be positive for their growth going forward. So just had to get this plugged in so we don't lose power. There we go. So we'll go into GXO, the conference call, etc. next week. We've got other ones that we spent more time on for this week. VF Corp. The name of the game with VF Corp is the fact that they're deleveraging their balance sheet. The sales are still down. They did have some big turnarounds in China, was really, really strong. I saw as I was going through the numbers today. The stock was up pretty big because after the conference call. But the key thing that was important to me, okay, Greater China all in, but it was by brand. It was one of the brands that was just off the charts in China. We'll go into it in more detail next week. But if you look at the balance sheet, number one, they generated, let's get this here. Okay, let's look at the long-term debt. It's gone from, in the last 3 quarters, it's gone from 5.7 billion to 4.7 billion to 3.9 billion. Now they got the 1.5 billion coming in from the sale of Supreme, which are going to take this down again. So now their balance sheet's going to be in good shape, which all you need is free cash flow and a good balance sheet, and then you have the runway to turn everything around. And you're back off to the races. So let's see here. Balance sheet review. Okay, free cash flow. Turn 31. Good. That's margin, North Face. Cost savings. Moderated. Okay, so he's still more energized than ever. That's good to see. We're going to go into this more. The conference call was good. You could tell by the way the stock acted today. And the key is the balance sheet risk is now off the table, which is like what we had to go through with Cooper Standard. And by the way, Cooper Standard's debt got upgraded today, which is mind-boggling and exciting to see. So next week, we're going to go into VF Corp in a very detailed way. But for now, we're pretty pleased with our first look in their turnaround because the solvency risk, which is number one, is off the table. They've got free cash flow. They've got a good balance sheet. Now they're just starting to turn revenues region by region. As for Temu sellers revolt against fines and withheld pay. So again, we've said for months that Pinduoduo and Temu the numbers are either unsustainable or unreliable. I think it may prove to be a combination of both. You can refer back to that article in the Financial Times. This is an article from Barron's saying that, talking about Intel, we're going to cover a lot of Intel today. And, it says from the start, Gelsinger said his goal was to achieve leadership in chip manufacturing by 2025. Sure enough, Intel's new processors called Panther Lake are scheduled for release in the second half of 2025. When I asked a senior Intel executive when Intel would finally be able to make a processor that's better at performance and power efficiency versus AMD's offerings, the person pointed to the new Panther Lake chip. There's a glimmer of hope for Intel on the horizon. That said, I'm not suggesting it's time to buy the stock. Intel has had too many missteps and false starts, pruning the weight. But basically, the case that this author is making, take him, is that a lot of these bad decisions were made before Gelsinger. Gelsinger took the helm at 2021. Many of Intel's problems stem from decisions made by his predecessor. It takes several years to hire the right talent, then develop, then design, then make new chips. We're going to go through it line by line in the article of the week, so just hang tight. China's yuan climbs to 7-month high on stronger yen, unwinding of global carry trade. This is what we've been waiting for, ladies and gentlemen. We've done the overlays over and over again for months about the yuan needing to appreciate, dollar depreciate, and Chinese yields on government debt start to go up. We're gonna talk about that in just a moment. Global carry trade, yen gains. Okay, we covered that. China's services activity expands. We covered that. Most popular trades are unraveling. This I covered with Charles. So what were the 4 most crowded trades last month and for many months before? Long, Magnificent 7. That's unwinding with the carry trade unwind. The second most crowded trade was short yen. We've had the biggest rally in the yen in the last 2 weeks that we've ever probably seen in history. 3 was short small caps. That started to unwind last month. It took a little hiccup this last week and a half. That's going to reaccelerate based on fundamentals. And the 4th most crowded trade was short China equities. And what did better than any other asset class in the last week? China equities. So that is what we've been waiting for. Global hedge funds actually added Chinese domestic stocks in July, says Goldman Sachs. This is Daly saying a policy adjustment is still coming sooner rather than later. Even though she's not worried about anything at all, she's still going to get that policy adjustment happening sooner rather than later. Nvidia, which we had talked about before it crashed, when everyone was clamoring all over each other to get stock after they did the split and sucked in all the new buyers. Jensen Huang sold $323 million of stock in July before the decline. He dumped it all on the retail investors' heads. So beware when that happens again. I think people got wise to it because Supermicro or one of those companies reported after the bell and they announced a split and the stock was down 9% after market. Biggest margin debt unwind since 1999 spurred Taiwan stock rout. That's why we don't use much leverage. Chinese brokerages talk up local stocks after global meltdown. Goldman says buying the S&P after 5% drop is usually profitable. We showed you the data behind that. Here's from Nick Timmeros from yesterday. Market sell-offs upends Fed rate cut calculus. A further slowdown in the labor market could lead to a larger half-point rate cut next month. So the Fed whisperer is starting to drop hints about 50 basis point cuts as a trial balloon for the Fed, setting the stage. That's pretty interesting. China defensive sectors win favor as Asian stocks stage rebound. And now on to our article of the week. Like a phoenix from the ashes, stock market and sentiment results. We talked about unwinding the carry trades. Here are the notes from the show you can go through. But Marcel Munch, many of you know from Germany, he's had me on his podcast several times to talk about China, and he's a China expert in his own right, particularly with China EVs. He actually reposted an excerpt from a podcast I did in March that was eerily predictive. Let's just put it that way. It was really crazy to hear it. I did on this exact subject about the carry trade in March that predicted the events that we've now seen in the past week. Why I'm going to replay this right now is because it also talks about what we were waiting for with the yen and with the Chinese yuan as an indicator for what would happen with Chinese equities. In other words, all the pieces are coming into the puzzle that should make Baba hum. We got earnings coming in, we got the new buyers coming in, but now the global macro things are actually benefiting to also offer support. Now, more important than the Fed this week as it relates to central banks, which is the Bank of Japan just handicapped a winning strategy, what to know about the yen carry trade. If you're in finance, you have to know about the carry trade. So this is a great article from Barron's that lays it out simply. What is it? It's very simple. You borrow money in a country with very low interest rates and then invest in a country where you can get considerably higher returns. Japan's central bank interest rate has been around 0 since 2016. The U.S. 10-year bond yield, by contrast, has been higher than at least 2% for most of that time. The pandemic was a lengthy exception. This is the general idea. Borrow money at 0% interest, carry it abroad to invest at 2%. The difference is your profit. It's a sure winner. Lending to governments is considered risk-free because there's virtually no chance they won't repay their debts. They can always print more money. Take your cash to other places than the US and your profits could be even bigger. For example, Mexico's 10-year government bond is currently just shy of 10%. Who does it? Institutions. What could go wrong? While it seems like a sure thing and mostly has been, there are still risks. Changes in interest rates and exchange rates can either reinforce or derail the strategy. For example, the BOJ's ultra-loose policy has driven the yen to 30-year lows against the dollar, which makes the carry trade even more profitable because you're borrowing in yen at zero rates, reinvesting in dollars, and making the spread, and then getting an appreciation in the dollar relative to the yen throughout that whole period. But if the yen starts to strengthen now, it will cut into carry trade's earnings. Rising interest rates tend to strengthen currencies by making investments in those currencies more attractive. The yen sold off on headlines that the BOJ would keep an accommodative policy for a while, but recent headlines are suggesting that further rate hikes may be forthcoming. The problem for the yen, however, is that volatility remains exceptionally low and the carry trade exceptionally popular. Is the carry trade dead? Probably not yet. Interest rates in Japan are still much lower than elsewhere. BOJ has said it will move slowly and cautiously, but the decision to raise rates does change the game, especially because the next move in interest rates in the US and Europe is expected to be down. The carry trade will almost certainly become a lot less popular. Who are the winners? This is the most important thing, and we've been hinting towards this for months, and this is key. China has the most to gain if the BOJ continues to raise interest rates, thereby strengthening the yen. China and Japan both rely heavily on exports of things like electronics and cars for economic growth, and a stronger yen compared to the yuan will make Chinese goods more attractively priced. It will also help to finally take the Chinese yuan off the mat and appreciate the yuan, which is the key that we've been looking at as it related to our exposure in China expressed in a position in Alibaba. And what we've been talking about is as the Fed eases and the dollar weakens, emerging markets will get bid and China will be a beneficiary. That is true. But what I laid out here, which is even more important, is the yuan's relationship to the US dollar. And as we can see almost perfectly, as the yuan rallied from 2000 relative to the US dollar, the yuan strengthened from 2016 to 2018. Alibaba had a parabolic move. The yuan strength is in black, the Alibaba is in red, and you can see as the yuan went up, Alibaba went parabolic, the yuan rolled over, Alibaba crashed down, and then the final rally as the yuan started to recover, you had that parabolic move into 2021 with Alibaba. Yuan rolled over, Alibaba and the rest of Chinese and K-Web stocks crashed. It's been doing this double bottom, and this could have been the sea change we have all been waiting for, ladies and gentlemen, that we get this double bottom in like we saw in 2019 and 2020 and a parabolic move up, and we get the yuan off the mat. Yuan starts to appreciate because the BOJ's new policy stance and the Fed's new policy stance, yuan being appreciative stance of tightening rates, Fed being depreciative stance of loosening rates, strengthening the yuan, which will cause the flows into China, into Chinese equities to explode yet again. No one can see that right now until it happens. And then this will be the most hated rally all the way up of all time. No one will believe it until it hits 200. Then they will hate it, and then they will join it. And that's what will happen. And today was the warning shot fired all around the world following the meeting when the Fed confirmed they were going to be dovish. And they have no choice. Bank of Japan has been the liquidity backstop for global central banks while they got inflation under control for the last 2 years. And now Japan is saying, we've got inflation coming. We want to normalize our policy. It's time for you to backstop us. We are going to normalize policy. And that is the global coordinated central bank policy that has worked so well. So now it's flip-flopping from strong dollar, weak yen, and weak foreign currencies to now weaker dollar, weaker euro, stronger yen, stronger yuan, and that will be great for Chinese equities. And I think the misnomer here for everyone chasing Japanese equities is the stronger Japanese yen, despite all the constructive developments as it relates to corporate governance and spins and shareholder-friendly policies moving in the right direction. I do think the stronger yen will be a headwind. The weekend has been a tailwind for the recent rally in Japanese stocks. It will now become a headwind. And all the Chinese flows that have come out of China and into Japan are now going to go back home as price starts to change opinion. Opinion follows trend. And this move here today, albeit it doesn't mean that it's going to do it tomorrow, but it's the beginning of this regime change that is significantly important for so many of the things that we're doing and for the global change around the world. This will also support small caps. This will also support REITs. This will also support dividend payers, code value stocks like Stanley Black & Decker, Generac, 3M, all these industrials that have been waiting to take off, natural gas companies like Comstock Resources, et cetera, et cetera, et cetera. So very excited here. The 10-year did not know what to do today. It started by collapsing and then it started to get bid up. I think what you're going to see over the next few weeks is while the dollar starts to re-weaken, the yen starts to get bid, the yuan starts to strengthen, the 10-year bonds are going to slowly climb and yields are going to slowly compress. Now, just as I always say with the Fed, because most of the time the move is bad after Powell speaks, and I always say, don't get faked out. The first move is often the wrong move. It may, in fact, be the case that that could be true this time as well. Could we be off to the races for 19 out of 21 weeks up in U.S. equities? It could be. That would be great. I mean, it was very interesting today. I think overall the portfolio was up 2.2% and the general indices were up between 90 basis points and a buck. So, our hedges were moving against us, but the overall portfolio was outperforming the deterioration of the hedges, as we're going to discuss in the article of the week. And it was a great day. 2.2% on any day is great. It was interesting to see, and maybe we'll get even further follow through, and this will continue for another 4 weeks. Who knows? I would be alert. That's all I was going to say. As a matter of fact, I was going to lean into the hedges today, but we already have full 2% of equity capital. That is sufficient to create an extra 10% of free capital if we're right on the 4 to 6% pullback over the next couple of months. But, I wouldn't, number one, I wouldn't be pessimistic because a lot of things are lining up right, and we're going to go through a list of them. And number two, I wouldn't be chasing if I wasn't already fully invested either, especially in the shiny objects that have already run. Because while you might get a few days follow through, I would just keep an open mind. Sometimes that first move is a fake out, and let's see how it plays out in the next few days. I think the real underlying move should be as we look out 4 to 12 weeks, yen starts to strengthen, bonds start to get bid, dollar starts to weaken, emerging markets get bid, U.S. maybe flattish to down, could be flat sideways, which we discussed 3-4 weeks ago. We said probably the move that screws the most people is the indices actually just grind sideways. So they take out all the put premium, they take out all the call premium. And I'd be open-minded to that, because that implies, now, moving along to Intel. On Thursday, August 2nd, Intel had reported earnings for Q2. Revenues dropped 1% year on year, and the stock dropped 30%, which is something to keep in mind, guys, to keep things in perspective. Revenues were down 1% year on year. The stock dropped 30% year on year. So what does Warren Buffett talk about? Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. So next quarter is supposed to be down 8%. So there's some substance to that. But then going into the fourth quarter, it's going to be back up to flat to up 5. And they're guiding towards the top of the range, up 5% year on year. Let's listen to Gelsinger on CNBC after he reported earnings.
Over time, at today's lows, Intel touching levels not seen in 11 years, since 2013. The company also announced the suspension of the dividend starting in Q4 and a layoff of more than 15% of the workforce. I spoke with CEO Pat Gelsinger in his only broadcast interview right after the analyst call last night, starting with the layoff.
It's hard. This is the Intel family, so I feel this very deeply. At the same time, making the steps to have an efficient Intel for the future that has both process and product leadership, but also a financial sustainability in the model. We're committed to this journey. This is the most substantial, restructuring of Intel since I'll say the memory microprocessor transition 4 decades ago. We have laid out on an audacious journey of rebuilding this company, and we're going to get that done. And today's announcement is accelerating the financial piece of that, even as we build on the product and process capabilities that we've put in place.
I asked Gelsinger about the reasoning behind these cuts, aside from the immediate need to preserve cash.
We're making these cuts to build a more efficient Intel. And what happened at the beginning of the year was we disclosed this new financial model, the new operating model of Intel, a world-class fabless company and a world-class foundry company. We began a clean sheet analysis of the two pieces of the business, and we said, what does world-class look like for each of those businesses? Because we were operating in the old model for 5 decades. And that clean sheet exercise led us to say, these are the changes that we need to be an efficient, nimble company for the future. That's what's driving the restructuring that you've heard us announce today. The financial performance accelerated that a bit, but the work was already launched and underway from the start of the year. And now we want to get them done quickly so that we have this new operational model in place and fully supported by a more efficient organization. So we expect the majority of these will be finished this year so that we're able to have a more efficient, effective Intel foundry, Intel products, and an overall Intel delivering product and process leadership with financial performance as well.
I also asked Gelsinger why an investor seeing the stock plummet today and seeing the dividend suspension would put money in now.
Well, we believe that those foundational investments are realizing beginning now. Right, these new products, we're seeing them come to life. And for instance, the AI PC is a great example of that. We have the leadership product today with Core Ultra. We're about to announce the next generation of that at the IFA show coming up next month. Lunar Lake, our second generation Core Ultra. Unquestioned leadership in performance and AI capabilities, dramatic improvements in power. Our next generation server products are shipping this quarter. So I'll say, all of this hard work that we've done starts to materialize now. And I think we've reset the financial expectations now, and we've taken the steps that the markets should look at and say, wow, they are really getting their house in order for a efficient Intel building on the leadership Intel work of the last 3 years. Now is the opportunity to start benefiting from those, and we believe that the guidance that we've given is now, well placed in the market. The steps we're taking, well respected, and with the products and the technology, we're now well positioned to begin a very solid cycle, for the Intel of the future. This has been heavy lifting, and we're now confident that building on that, we can go forward effectively in the market for the future.
It was a tough quarter a few back, and the hope was that there was a trajectory after that point that would be more predictable. We're here now, and it sounds like you're saying that again. At what point do we know that those kinds of surprises and the needs for realignment are out of the way, or is this just such a rocky period for Intel and the changes that are needed in the industry that you can't say?
Clearly, this has been a challenging rebuild. This has been an audacious rebuilding of Intel, one that I'm proud of the work that we've done. Rebuilding a company like this is heavy work. We always said it was going to be a 5+ year journey. Here we are 3 years in. We've accomplished the most significant process technology, cycle. People didn't think it was possible. Now, the end is clearly in sight as we've released the PDK, the products have come to life. These are significant milestones, ones that people thought were impossible 3 years ago. They're now done, John. And building on that, these new products that we're bringing, these are competitive products. We're no longer in a position that we're losing market share because we have inadequate products. And our AI products, AI PC, our Gaudi 3 that we're beginning to ship this quarter, all of these things are now coming together. So yes, I understand some of those concerns, but I'd also say, look at what we've gotten done. This is incredible what we've gotten done, and we're now combining that with the steps to build a more efficient Intel. This is the most significant rebuilding of Intel in 4+ decades. I'm proud of the work we've gotten done, and we're committed to finish the job, and we are well on our way to do exactly that.
A lot riding on Gaudi 3 as that launches and ramps in AI PC. We'll see where Intel goes from here.
And we're back. So I put out a note after earnings, which I usually don't do, by the way, on Twitter X. And I said, I quoted him, launching in Q3. The big thing here is people are saying, wow, their numbers are so bad. But it's like trying to sell cookies and your product is still in the oven. So the product that everyone wants right now are AI chips, GPU. What are they selling is CPUs, which has been their legacy business, which they're obviously still doing, $12, $13 billion a quarter, not too shabby. But the products that are going to really move the needle for them are going to be the GPUs, which are actually just launching this quarter, so the game hasn't even started. They're holding their own. They're able to maintain their revenues basically flat year on year, but they don't even have the products in the market that the market wants right now, which you could say, well, why don't they? Because of all the bad decisions that were made, that Gelsinger is writing with the 4 nodes in 5 years, which is now basically complete. But the market is too impatient, which creates the misappraisal that creates the opportunity for people like us. So launching in Q3, Intel's Gaudi 3 will take accelerated performance to the next level at just 2/3 the cost of competitive offerings. To put it in perspective, we expect Intel Gaudi 3 to deliver roughly 2 times the performance per dollar. So on both inference and training versus NVIDIA's H100 chip. So half the cost, twice the performance, 40% more energy efficient. That's going to be a competitive product, especially because what did the NVIDIA people used to say? Well, it doesn't matter. By the time you have your Gaudi 3, we're going to have Blackwell. Well, Blackwell got delayed due to engineering problems. So it's going to give Intel a 3-month window to get this chip out there where everyone's going to start to say, wait a second, half the cost, twice as efficient, more energy efficient, which cuts my overhead, and Intel's going to gain some share here. So like I said, very hard to compete when the desired product is still baking in the oven. That changes in Q3 for Intel, which is now second quarter revenue down 1%. stock dropped 30%. Q3 is expected to be down 8%, also weaker for the industry. Then Q4, Intel guides back to the top of range, plus 5% revenue growth year on year. As much as Intel disappointed from what they are communicating, it looks like a temporary impairment versus a permanent impairment. It will take longer, but time will tell. Price is what you pay, value is what you get. No one knows if price will go lower or higher in the short term, but I'll take my chances on a firm that is set with government backing and support to become the leading AI systems foundry and the second largest foundry in the world by 2030. Leading AI systems foundry and second largest foundry in the world by 2030. That's Gelsinger from Q1 of 2024. And you can see their products. We're not going to go into that right now. But I also want to go into, before I go through all the earnings and the transcript and all that other stuff, I want to go through a couple articles that I thought were really helpful. Okay, so this is from Market Watch. It says Intel's worst drop in decades may have been steeper if not for this factor. The US government cannot afford to let Intel struggle over the long term, one analyst says. Well, maybe two analysts, because I've been saying that for the last few weeks. Investors may have a sense that the company will be safe in the end, despite its challenges, thanks to Intel's standing as a domestic chip manufacturer at a time when governments are interested in propping up local players in the chip market. In other circumstances, we believe we would now be having going concern conversations with clients. Bernstein's Stacy Ragson wrote a note to his clients. By the way, that's what the stock is trading like now, and that is not on the table. Quote, just like Cooper Standard when it was trading at $5 and $4 and $3 when we were pounding the table. To that end, and perhaps the one positive, subsidies and partner contributions, when combined with spending cuts and dividend suspension, look set to add $40 billion of incremental cash to the company's balance sheet through the end of 2025, suggesting Intel will survive in some form to continue the fight. And that's the whole key with turnarounds is runway, right? The subsidy point is intriguing. Intel struck a deal with the U.S. government earlier this year that awarded the company $8.5 billion in direct funding as well as $11 billion in loans through the CHIPS Act. That's government program that's meant to bolster the U.S. position in chip manufacturing, and one that shows officials are thinking more seriously about how to help players compete in this vital industry. Moving on. Given the increasingly critical role that semiconductors play and the precariousness of geopolitics, governments, including the U.S., are making domestic chip capabilities more of a priority. Intel sits in an especially important spot for the U.S. because the company manufactures the chips itself. That's the thing. NVIDIA and all these other companies that don't manufacture their own chips, they are going to be at the mercy of Intel and Taiwan Semiconductor, which are going to have a duopoly. Our country and government cannot afford to let Intel founder and really struggle long-term, Mizuho desk-based Jordan Klein said in a note to clients. But Intel stands out. The U.S. government has a vested interest in Intel being a real player in foundry and winning at the leading edge, Klein wrote. Intel is too important of a long-term strategic asset. This reminds you of what? Of Boeing, okay? That's why Boeing hasn't been taken out to the woodshed, because it's a duopoly. That's what Intel's going to be with Taiwan Semiconductor. Taiwan has taken U.S. chip business, one factor that led to a sharp subsequent decline in chip stocks, though Intel stocks escaped that session unscathed, demonstrating how investors view the company as the one that could benefit if nationalism comes to play more of a role in the industry. Intel's conundrum parallels to that of Boeing, another domestic titan besieged by execution issues that have pressured financials. But while Boeing isn't a major financial institution like a too big to fail banks, the company operates as the domestic half of a duopoly with Airbus, and it occupies a key position in the defense and aerospace markets. Boeing is an iconic business and major employer, and the U.S. government likely has a vested interest in its success, as well as Intel's. Intel's plan is to grow first and to shrink. Intel's plan to grow first to shrink with layoffs, reorganization, and suspension of its shareholder dividend. Yet the news from Intel's second quarter earnings report on Thursday wasn't all bad. Pat Gelsinger continued to reiterate the company's ambitious plans for 5 nodes in 4 years to enable its foundry business for both internal and external customers to catch up to Taiwan Semiconductor manufacturing is still on track and executing as planned. That means the critical 18A process node will indeed power some of Intel's most important products over the next 2 years. The ability for Intel to be a key competitor in the foundry space remains the primary focus of the company's leadership. Intel has shipped more than 15 million of its first AI PC chips, codenamed Meteor Lake, and is confident will have 40 million units shipped by the end of 2024. That's a huge milestone and dwarfs what AMD or Qualcomm could hope to do in the same time frame. So that's that. Let's cover here. There's so much to cover. You really, if you are thinking about owning it or already own it, you really need to read through these parts that I highlighted. We'll be here for 5 hours because it took me 5 hours to do. Okay, as it relates to fourth quarter, with an expectation of healthier inventory positions exiting the quarter and continuation of enterprise refresh cycle, we should see revenue growth at the high end of seasonal in the fourth quarter. So this is a short-term blip until they get the new products, and a seasonal blip as it relates to the next quarter that you just have to kind of see through in the short term. Mobileye revenue. So some of their non-controlling businesses weren't doing well. Mobileye, although it improved and they expected to get better, their Altera was a train wreck. That hurt them a little bit. But on balance, let's just get to some of these stars. Operating cash flow was $2.3 billion, up approximately $3.5 billion sequentially on better working capital. Gross capex of $5.7 billion was more than offset by $11.5 billion in grants and partner contributions, highlighted by Apollo's SCIP investment in our Ireland factory operations, resulting in adjusted free cash flow of $8.2 billion. The key is runway here. Revenues were down 1% sequentially. We're down 1 point year over year, but their revenues were actually up 1% sequentially. Revenue was in line with the range we provided in May after receiving notice of an export license restriction, which negatively impacted our business in China. Intel Products and Intel Foundry both delivered 4% year-over-year growth, offset by headwinds in our more cyclical businesses. So there's a lot of good stuff under the surface. It's just most people shoot first, ask questions later, but they can buy it from us down the road at 80 or $100. We'll be happy to help them out when they get excited and they actually start to read stuff. Launching in Q3, Intel Gaudi 3 will take our accelerator performance to the next level at just 2/3 the cost of competitive offerings. To put it in perspective, we expect Gaudi 3 to deliver roughly 2 times performance per dollar on both inference and training versus H100, NVIDIA's H100. Gaudi 3 has a strong ecosystem supporting Dell Technologies, Hewlett-Packard Enterprise, Lenovo, Supermicro, Foxconn, Gigabyte, Inventec, Quanta Cloud Technology, and Wistron. Then they talk about their Intel Xeon 6, codenamed Sierra Forest, 25% better performance versus competitors. Granite Rapids will be shipping later this quarter. That's also off the 18A server product. Everything is falling in place. 130 million Xeons powering data centers around the world today. Greater delivery performance efficiency. So people forget, this is a business that's still doing $50 billion a year. Yes, margins have contracted. Yes, they didn't get the new products out quickly enough, but they still have unbelievable franchise. No one can compete with them on the AI PC refresh. They're going to do 40 million. They've already done 15 million. They're going to get the GPU chips out cheaper, faster, better. Revenue will bounce back by Q4. And the 5 nodes in 4 years are done. And then the other thing, you look at adjusted free cash flow, you look at some of the things that are up. Certainly data center and AI was down, not good. Total Intel Products operating income was up. Operating segment revenue was up. So the key things that matter, desktop, notebook, everything was up materially. It was some of these other non-core. Altera shit the bed, okay? And it was down from 848 million to 361. It's in their all other category. This is their stuff that they don't care about anymore, like Mobileye, and eventually they will completely divest of. So if you put it in perspective, Lunar Lake, our next generation AI PC, which achieved production release ahead of schedule in July, will be the next industry-wide catalyst for the device refresh. Lunar Lake delivers superior performance at half the power with 50% better graphics performance and 40% more power efficiency versus the prior generation. 3 times more TOPs gen on gen. So each thing is getting better and better for lower and lower costs, which will create competition in the marketplace. So the long and the short of it is we bought more. We brought our basis down now to low 24s, and we'll just stick with it. We're very happy with that. We bought a meaningful amount on some on Friday and some on Monday and a little bit today, and it could go lower from here. We'd be perfectly fine with that. Moving on to Cooper Standard. So I read this Moody's upgrading. By the way, see our historic thesis and updates for Cooper Standard since May of 2022 when we entered the position at a basis in the low 5s. Okay, so just today, Cooper Standard debt got upgraded, okay? And what they say is, okay, the upgrades reflect a strong rebound in earnings since 2022 that has led to significantly lower leverage, improved liquidity, and reduced risk of further debt restructuring under the still burdensome debt capital structure, sustainable price adjustments, and cost recoveries from customers, a transition to a more index-based commodity input cost contracts, and rigorous focus on continuous improvement have been instrumental in generating improved operating results. In addition, headcount reductions announced in mid-2022 are expected to generate $20 to $25 million in savings in the second half of 2024 and generate annualized savings of at least $40 million beginning in 2025. Modest returns in our expectation for negative free cash flow through 2024. Since 2023, the company has stemmed the margin erosion it had experienced prior from operating inefficiencies caused by lower and uneven vehicle production volumes, as well as challenging cost input environment. Cooper Standard maintains solid market positions in sealing systems and fuel and brake delivery systems and fluid transfer systems, where demand fundamentals are largely drivetrain agnostic. A product mix skewed towards SUVs, CUVs, and light trucks, including content on top-selling vehicle platforms, help mitigate the competitive, highly fragmented nature in core and end markets. The stable outlook reflects our expectation that supply chain cost reductions from lean initiatives and heightened focus on continuous improvement will help sustain current returns. Ongoing rationalization of cost structure combined with higher margin new platform launches replacing lower performing programs should help offset the impact of softening global light vehicle production volumes and enable margin expansion through 2025. Reflects our expectation that the company will maintain adequate liquidity, cash balance of about $100 million, even with the negative free cash flow. Why do they have negative free cash flow? Because they're now, they elected not to do the PIK. They're doing cash pay on the debt. Contributing to cash shortfall is the expiration of the PIK options on the secured notes in 2025. We do anticipate the company to make progress toward generating positive and sustainable free cash flow in 2025. The undrawn $180 million asset-backed lending facility had availability of $173 million at June 30th, 2024. The ABL was amended in 2024, extending the expiration date to 2029 and reducing the facility to $150 million from $180 million beginning March of 2025. Okay, so that's not me and that's not Cooper Standard writing all of those good words about Cooper Standard. That is Moody's, a debt rating agency, writing that about Cooper Standard. So what did they do? Even though car volumes have not come up and they've actually come down, they were expected to be 16.1 million. They're only 15.8 million expected. They were able to grow their margin profile. So their gross profit was 82 million, an increase of 6.7 versus the same quarter last year. New business awards 60.6 million. But the key is, we're going to get into some of these key things here as we get into the earnings call transcript. You see the fluid handling systems grew by about 5 million. The decline in revenue was just due to the business that they sold that was no longer included. So if you add back the business that was in from the quarter that they're comparing to, their revenues were actually up modestly, even though volumes were down because of the efficiencies and because of their improved products and improved pricing. The overall guidance stayed basically the same. Adjusted EBITDA 180 to 200 million versus 180 to 210. And that includes the cash pay. They were deciding whether they were going to cash pay. They decided to cash pay, which shows they have confidence in the back half of the year business. And they've still got $266 million of liquidity. You can see where they gained in adjusted EBITDA year on year was their manufacturing and purchasing efficiencies, volume and mix, and their savings from restructuring, which is going to come up even more this year. And then year to date, same three areas improved. And you can see why the sales were just a hair less. 27 million of the revenues, 1.4 billion to 1.38 billion. You lost 27 million from the European tire business that they sold, which was non-profitable. Otherwise, their net sales were actually up year on year. So they've got more cost savings coming. You can see the 80% more parts for hybrids than ICEs. And there's some key points here. Look at the debt maturities. Nothing until 2026. They've got 43 million, and then 2027. So they're going to refinance between now and 2027, 3 years from now. They get a couple quarters of positive free cash flow. Rates come down if they do 250 basis point cuts and refinance the whole thing, take their debt thing down and push it out to 2030, which is all the runway they need for volumes to come back. In the meantime, they are operating like Simone Biles on a walking plank, getting gold medals because their margins continue to go up. They're extracting more and more profits out of less and less volume. That volume will come back. And they cut out another 16 million of savings through lean initiatives and other cost programs. They improved their gross margin by 100 basis points compared to the second quarter of last year, and 61 million of net new business awards. They outpaced global automotive production, which declined by 0.5%. Their revenues were actually up 1% when you back out the divestiture. So they outperformed by 150 basis points in terms of top line. Gross profit for the second quarter was 11.7% of sales. This compares to 10.7% of sales in the second quarter of 2023. Adjusted EBITDA was 50.9 million compared to 47.9 million. So that's positive. They're getting more with less, and wait till they have more with more is going to be a big deal. Despite lower sales. Despite lower sales, our business was actually more efficient as gross profit increased to 144.6 million for the first half of the year, and gross profit margin improved by 190 basis points versus the first half of 2023. Adjusted EBITDA for the half was 80.3 million, up 33% versus the prior year 6 months. And the technical rubber divestiture was 15 million. $9 million of improvement for the quarter. Manufacturing, liquidity, 267 million. Okay. This is very important, and I'll probably see them at JP Morgan on Thursday if I can get to a flight afterwards. We've got to move some things around. We'll see. Let me assure you that we're 100% focused on this task. They're talking about deleveraging and refinancing. Given our leadership, frameless sealing system growing at 30% CAGR for the next 5 years. Go through this at the hedgefundtips.com. There's so much amazing stuff in here. I saw the headline. I was like, that's a mediocre quarter. And then as I read through it, I was pretty excited with what I saw. And particularly in the question and answer period was especially exciting because he said, hey, wanted to follow up on Mike's questions on the margins. I guess at least 10% EBITDA margin without volume growth. Doing the math, that would imply 270 million of EBITDA exiting 2025. Am I doing the math right? Jeffrey Edwards says, yes, you're doing the math right. I mean, if they do 270 million of EBITDA exiting 2025, remember, going back to 2017, when they earned $7 a share, they were doing about 400 million. We're starting to knock on the door here as the quarters move. And once the volume ramps up to 16 and a half with all of the cuts and the pricing agreements that they have in place, I think when they're doing similar volumes, they're going to wind up doing a lot more than the 7 that they were able to do. So and they continue to emphasize getting to double-digit return on invested capital, double-digit adjusted EBITDA margins, and everything else. So that's that. Fear and greed down to 21. That's times to be a buyer, not a seller. And you'll probably get a few opportunities over the coming days. Moving along, earnings growth, 11.5% earnings growth versus 8.9% estimated. That's not really what you see during recessions, ladies and gentlemen, Somme rule or not, which is why we remain constructive, as well as estimates have actually gone up in the last few weeks, over 1% since January 1st. So for those of you who don't like the AMA section, we'll see you next week. For everyone who likes the Ask Me Anything question, let's get right down to it. We don't have too many this week because the call is so early. But we're going to cover the ones we have. We do have like 10. Ulta at 12 times earnings. This is from John Fies, very cheap and buying back shares. Looking to expand international. Any thoughts on looking into this business? Yeah, I will. I've looked at it and looked at it and looked at it, and I think this is going to be an error of omission where I just don't get involved, because when all is said and done, it's still a bricks and mortar retailer. But yeah, I mean, it's getting to that point where it's attractive. You look at the free cash flow is kind of holding in there. Revenues are going up. Return on capital is strong. Margins are holding in. So would I take a punt on it? I think you're probably okay, but at the most, over the next 3 or 4 years, you're probably barely looking at a double. So when something's not like super easy and straightforward to me, and the return over 3-4 years is less than a double, I just immediately take a pass. But I'll take a look at a couple of these things. Let's take a look at cash flow. So it's fine. They're doing $1 billion of cash flow. Let's take a look at their income statement. Revenues have been flattish, but they're going up in the right direction. Balance sheet's probably fine. $520 million of cash. Is this possible? They have no long-term debt with retail stores. Wow, that's pretty amazing. Return on capital. I don't know. This has been on the watch list for a while. I think you just have to understand what's the growth profile moving forward, John, because there's others like Sally Beauty that are really in trouble, that haven't been doing well. So if you can understand its competitive advantage and how they're going to sustain that, I think you might have something here and it might be worth an investment. But just looking at the numbers, let me take a look at the margins. Margins are holding in, they're down a little bit. But if you can get comfort with their competitive advantage and understand why are they actually down almost 50% in the last 6 months, and feel good about that. Also check comparable store sales versus overall sales. That could probably be a tell as well. Five Below expanded a lot of stores to grow sales, but their comp store sales were down. And that might be the problem with Ulta. Also, people are worried a little bit about the consumer. So if you can get comfort about all those things, you might have enough margin of safety to make an investment here. And I think you did pretty good work on that one. Let's go to Jay O'Hare, regular listener, second time AMA questioner. With the possible topping of chip stocks like NVIDIA. What do you mean possible topping? It's down 40% in like 6 weeks. And AMD, would you agree that the next big chip stock will be an energy or data center company, since they're powered, run massive computational power? I'd play it with natural gas, Jay. That's what I would play it with. I'd play the energy. I wouldn't even go there. And I think the chip companies with the large enough margin of safety, like Intel, the way I would play that, Jay, I think your thinking is right. The way we're playing it is through Comstock on the natural gas side and Intel on the chip side. Jack McCarthy, thanks for the great content every week. Was waiting a long time to finally be able to ask you this. But do you think now that the Bank of Japan has finally had an interest rate hike that the Chinese yuan will have a massive rally? Yeah, it's already happening, which automatically means BABA will be bid. Yes, in my opinion, that was the most important catalyst which had to happen. Just wanted to see if you see it the same way or are missing. Yes, we've covered it 100 times over 3 months. So yes, it's happening, Jack. So let's hope we get a good earnings report and we can finally be off to the races. So yeah, thanks for hanging in there. And these things all work out sooner or later as long as the framework is correct. Loam Van Dam is asking about Prosus. Prosus is basically a way to buy Tencent at a discount. The problem is they've been selling Tencent, so I wouldn't mess with it. If you like Tencent, just buy Tencent. Jim Jones, if you want exposure to natural gas and coal, what would you look at? We own Comstock Resources. Jerry Jones is our partner, owns 66% of the equity, also owns the Dallas Cowboys, and he thinks that Comstock is more valuable than the Cowboys based on past interviews. And based on how we think about the reserves, we agree. Mark Mayello, thanks for everything. Learn more here than all the books and podcasts I've studied. What are your thoughts on Walgreens stock? Is their debt and leaches too large? Can they manage to come back? I think they're probably going to be the last man standing, but it's a garbage business, and I really don't want to do it at any price, so I'm going to pass on that. But I think you might, I think we've covered that one a couple times, and I think it will probably work. But this stuff, it's revenue's going up, cash flow's negative, margins negative. I mean, this is one of those that are better for a trade than for owning. Like Rite Aid is bankrupt. I think this might be the last man standing. I just don't want to be in the space. There's too many counter wins with the pharmacy benefit managers, with Amazon, with direct to consumer. I just don't want to play there. They used to make all their money selling cigarettes. Now that's gone. Christian Dye, Cebu Air, their duopoly and LCC, Air Asia groups, stuck at hammered. Only company that did not need to restructure their debts. Last thing I want to buy is an airliner in Asia, but let me take a look. Cebu. If I want to buy a garbage airline, I'll buy one in America. Let's see. Cebu Air. I don't know. Can I get the regular ticker here? CEBU. Yeah, massive negative free cash flow. I don't want to mess with this. Let me see about the debt. We got $250 million of cash. $1 billion of debt. Negative $500 million of free cash flow. No, this is a train wreck. I'd pass, Christian, at any price. Jacob, what do you think about Intel after the latest quarterly results? Oh, I didn't realize they reported. Let me look into that. Kidding. Actually, we just covered it. Thank you for the great question. All right, David Martin. Found you on TikTok a few months back and have become an avid listener of podcasts. Thanks for helping us out. Us very sub 1 million accounts. Curious to hear your thoughts about adding to my positions. I totally understand dollar cost averaging at lower prices, but when, how, or would you add to a position once it starts to move up? Never. That's me. I buy down, not up. I buy red days, not green days. If you need an actual stock, we can use CPS as an example. No, I just buy CPS when it's red and I have cash, period. That's very simple. I never buy it when it's going up or green. And we've got plenty. So we're happy with our positioning. We're happy with our basis. And now we're just going to let John Edwards and team, Jeff Edwards and John Vanis work their magic, continue to execute until the volume. I mean, they basically got this thing running like such a well-oiled machine at such low volumes that they could be cash flow positive next year, assuming no growth in volumes when volumes are going to grow when the average car on the road is 13.5 years and the average millennial is 33 years old. That's when they buy the most cars and dishwashers, which, for those of you who've asked me about Whirlpool, and homes and baby stuff between 33 and 40. And this time will be no different, and they're going to be the beneficiaries. So in fact, they can go cash flow positive in the next year, assuming no volume growth, when volume growth is going to come back. Rates are going to come lower, inventories are going to go up, OEMs are going to start to give incentives, volumes are going to start to go through the roof, margins for OEMs will go down, but that all we care about is volumes, and they will be a key beneficiary. So I hope that answers your question. We'll be back next week, same time, same place. In the meantime, we'll be back at our normal time, normal place. In the meantime, make it a great one. Thanks for tuning in. Have a great week. Bye for now.